of the amendments that have been proposed to the Partnership Act to facilitate PE investments. So a round of applause for Fiona, who's joining us this afternoon. Next to Fiona is Kim Kamarebe. Kim is a managing partner at Inua Capital, but also at Inua Impact Fund, a fund manager registered in Uganda, domiciled in Uganda. Kim has had experience before in Europe and the USA and other investment funds in Uganda, and we are delighted to have her on the panel. So welcome, Kim, with a round of applause. And last but not least is Dennis Otatina, and for purposes of this conversation, we shall be referred to him as Ota. It's his other nickname. Dennis is a managing partner at Denton's Uganda. If I'm not mistaken, Denton's is the largest law firm in the world. Yes, so welcome, Dennis, to the panel. So our panel has two things that we are discussing today. The first one being domiciling local funds in Uganda. Okay? That's the first part. And then the second part is about investor confidence in the Ugandan market and how do, especially our lawyers, structure instruments that protect investors at the point of both investment, but also at the point of enforcement of rights. So I want to begin with the first topic and invite Kim, who has registered a local fund in Uganda, to share her experiences around, one, fund domiciling in Uganda, the practical considerations, but also the challenges and the way forward. And then I'll invite the panel as we go along. So welcome, Kim.
Thank you. Is this on? Thank you, Stephen, for that introduction. And before I begin, I just want to say that I'm very, very thankful to the CFA Society of East Africa. The idea that this conference is even taking place, really for me, is very much a culmination of the work that I've been trying to do in this country for the last 15 years. 15 years ago when I moved here, the idea of alternative investments and what it meant did not really exist. And I remember, and even before I moved actually, in 2006, I remember working with a young legal officer at CMA trying to help them recraft the venture capital, what was to be a Venture Capital Act, then moving here in 2009 and working with the CMA to create a master plan to create alternative investments as an asset class, and to consider it and to understand that there needed to be regulation around it before it can be attracted into the market. Working with what has now become UBRA, while it was still sitting in the Ministry of Finance, to create that little slot for alternative investments. In fact, an interesting story about this is that we had a working group to create what the different investment classes that investment managers could invest in, and I was the only one in the room representing alternative investments. And so they had put there, other 1%. And I was like, that can't work, right? Other 1%. There are multiple asset classes here that we're not referring to explicitly, that we're not, if we don't promote them and explicitly explain what they are, why will a fund manager? And so really, today to see, alternative investments really take its place amongst other asset classes in the country, to see the number of charter holders in the CFA expand to the numbers that we have today is a real, real privilege, and I'm very grateful for all the work that everyone in this room and beyond has done to help us build an industry that is fundamental for our economy. So thank you very much. In terms of domiciling a fund, as I mentioned, I moved here in 2009, starting I was the first. So when I moved in 2009, there was an agricultural private equity firm, or a firm that had transitioned into becoming an equity firm. That was Pearl Capital Partners. And beyond that, there was no sector generalist fund here, not even a regional fund with an office, nothing. So I moved here to be the first. My personal vision moving from the UK was to be the first locally resident fund manager here, with the intention of helping to build an ecosystem. Because one of the main reasons that you had big PE funds it was at the renaissance of regional private equity. So East African PE funds were being raised, but none of them were opening offices in Uganda because they were like, we can't get good talent, we can't get good lawyers, we can't get good accountants, we can't get good valuers. So why should we set up there? Instead, we would rather have someone like you be a finder and do us a deal there for a fee. And it was very clear that that was unsustainable. And even in the fund that I was creating, so a colleague of mine from Goldman Sachs and I had resigned our jobs at Goldman Sachs to create a fund. And even with that fund, every funder that we were talking to said, yeah, locate in Nairobi, you'll be in Westlands next to this other firm. And we said, no, our first deal is in Uganda, so why shouldn't we locate in Kampala? And they were just like, why? What's wrong with you? And we realized that a lot of work needed to be done to help build an ecosystem in Uganda, or that trend and that boat would miss us. And we would not develop the industry, the talent, to be able to have alternative investments, particularly private equity and hedge funds, which I was focused on here. And what that meant is that if you're in an unenabling environment for capital, not only do things like this not happen, there is no job for a CFA, so they don't pursue it, but also less and less capital gets allocated to your region versus other regions that have a more enabling environment. So we decided to come and do the brave thing to set up here. And initially we had the intention of domiciling here. And this is how I met so many people in this room and beyond, NSSF, the ministry, CMA, and so on. And it very quickly became clear that it would not be profitable to our shareholders who had given us capital to invest here because the regulatory environment did not allow for it. So we chose to do two things: physically locate here, domicile in Mauritius, and do all the hard work to work with the different institutions, be it the CMA, NSSF, that was a potential investor at the time, and so on, to try to create an enabling environment either for our subsequent funds or for those who came after us. So that's how I came here, and that's how I got very familiar with the challenges of setting up a fund. And this is now the fourth fund I'm running, and only now have we finally domiciled a fund in Uganda. So all the other funds that I've run prior to this have not been domiciled in Uganda. It is an expression of progress that ourselves and Pearl Capital are invested here, but the challenges are very many. Realistically, neither of those funds have a shareholder who is going to make a return off of a fund domiciled here, because the regulatory environment is still, for lack of a better word, hostile. It does not explicitly understand and cater for pass-through vehicles except collective investment schemes. What that means from a very practical perspective is that for us who are a fund with shareholders who are themselves funds or entities that are companies, they are, for every dollar that is made in the businesses we're investing in, they're exposed to somewhere between 68% to 87% tax on that dollar. And as an SME investor, remember that we're impact investors. We don't invest for a high return. So if we make 10% return in a company, let's say we invest $100,000, we make $10,000 in that company, 87% of that is going to be taxed. So only $1,300 is going to come to Inua. By the time it pays to have Inua's lights on and pay salaries, our shareholders are always in the black, in the red, whether or not the companies we invest in are in the black. That is still a very disenabling environment for funds. Why then have the shareholders that have invested in me agreed to invest in me and domicile here? For a number of reasons. The first is that they're catalytic shareholders, and they believe, as very many conversations with the entities I've told you have shown, that people will say that why should we create regulation and change regulation when there is no one that it affects? So we wanted to be one of the first people to feel the pain of domiciling here and clearly demonstrate it, with the hope that it would catalyze local regulation to change its stance and its posture. That's one reason why they do it. The second reason they do it is that ultimately SMEs deserve the capital. And if we don't start creating the other parts of the ecosystem, the talent, the relationships, things like this, then ultimately the boat sails and everyone loses out, themselves as well. So it's really because they want to be catalytic. But the main reason I would say that they've invested in this fund is because ultimately our fund has a goal for 100% of our shareholders to ultimately be Ugandan. That is our goal. Our goal is to transition from our current shareholders over time to 100% Ugandan shareholders. And given that the law for institutional investors in Uganda is that they cannot invest outside of East Africa, it made sense for them to feel that pain in order to try to catalyze local investment into SMEs. So for me, what I would say, the challenges are very many. The biggest is the language in the CMA Act is very specific and it excludes certain kinds of structures and the ability, certain kinds of asset classes. Equally, in the absence of investment regulations, we are subject to regulations like investment managers when that's not actually what we do. We are subject to a double to triple taxation environment depending on the shareholder in question. We struggle very much to educate and attract local investors. I would say those have been the biggest challenges domiciling here. But for me, it is still worth it because, as I said, our role is to be a pioneer, as Pearl Capital has been for many years, and to really try to attract capital and conversations towards creating an enabling environment for funds in Uganda.
Thank you very much, Kim. A round of applause for Kim. I want to move to you, Dennis, now on, and I know you've been involved with Pearl Capital Partners also for a while, to discuss with us the legal regulatory bottlenecks that Kim has highlighted in broad terms, but with the specifics in terms of registration, tax issues, and then I'll move to you, Fiona, for the future of the amendments. So over to you, Dennis.
Thank you, Stephen. Glad to be here. The tax scheme has mostly spoken about, and she's absolutely spot on the challenges, starting right with the Capital Markets Authority, the regulation. We know that there is a real tough attempt to change the law and bring it up to speed. The field, the investment space, the alternative capital investment space out there is extremely developed and quite ahead. That one of the biggest challenges we face in setting up a locally domiciled fund is the expectation that whatever works there will work here. So you find that most times you're having to push back, and the council representative for an investor looking to set up a fund is saying, but that doesn't make sense. How can you not have that? A real example is an investor, you're fundraising, and an investor says, all right, so when we set up this fund, the term, the investment period is, say, 13, maybe +1, so that's 15 years. And they're saying, we want to get our capital and leave. We want you to register this company so that at 15 years, it automatically ceases to exist. And you say, well, we don't have that in Uganda, we can't do that. And they say, oh, but they do that in Mauritius. They do that in South Africa. They do that here and there. How can you not have that? What's the problem with having that? What's the downside to having it? And say, well, we are trying to push through some changes, but that's not possible. I said, oh, all right, let's check with Mauritius, we'll come back to you. And there you know it's done. There are things like directors. So I want to invest, but I don't want to have directors in the company. We faced a real challenge with the yield fund when one of the investors, Popako, said, we want to have an oversight committee that makes decisions so that the directors can stamp them under Ugandan law. And they said, where does that fit legally? You say, but you're a shareholder, make these decisions as shareholder. I said, no, we want another body. The shareholder is a corporate entity, but we want another body that is going to make decisions that are binding on the company as if they're directors. We said, no, in Uganda, directors bind the company. Director and company secretary sign the document, or two directors. They said, well, find a way. If you can't find it, we're not investing. We say, well, come and become directors. Why don't you just send people to become directors? They say, no. We don't want to be exposed to the liabilities of a director in your country. I'm sure your company's act sets out offenses to be committed by directors that might be committed by directors, or omissions, penalties, and all that. We don't want to risk. We don't want to expose our people to such risk. We just want an oversight committee that makes decisions, and the directors will simply sit and rubber stamp them. We say, but we're going to first of all struggle to find directors willing to do that, because you're exposing them. They're not the ones making the decision, but you want them to be bound by them. We say, all right, why don't you have a director sit in, and we give you a professional indemnity cover, director cover. We say, no, we don't want any form of risk, any form of exposure. We say, all right, so why don't you come be an observer on the board? Say, no, we want to make decisions, we want to vote. Say, but you can't vote if you're not a shareholder or director. How can you vote in the company? There's nothing in the law that gives you that space. And they say, politely, say, all right, let's circle back and come back to you, and that's the end. So even before registration, even before you go through the challenges with tax, the law is not as forward-looking as in other jurisdictions. We appreciate especially what Kim said, that the legislators are saying no one is suffering, why should we change the law? But if you look at it, people are suffering, it's just that you don't know about it. People are just stepping back and saying, Uganda is not viable, let's do this in Kenya. You look at, I'm sure Fiona is going to speak about this, the definition of a venture capital fund, saying it's a company limited by guarantee. But then, on the other hand, you have partnerships, a limited liability partnership that can work. They work everywhere else, South Africa, all over the world, they work. But the investor is saying, the shareholder is saying, I want this body to be licensed, regulated. I need it to have a reporting line. But the CMA is saying, sorry, you're a company, we cannot. The law just doesn't allow it. We say, all right, what if we do this, that, and the other? Said, no. Okay. So we are a company, for instance, Yield Fund says, we are a company. We're not an LLP, we're a company. Can you regulate us? Say, well, if you look at the definition in the CMA, it says that 80% of your investment must be equity. Now, who's going to do that? Who's going to take an SME and invest 80%? And how are you going to find value? If you're investing, say, $2 million, $3 million, that's your ticket size, that means you have to find an entity whose book value, business valuation, is what, $2.5, $2.6 million? How is that an SME? And Capital Markets Authority will say, well, we're going to come, ask for returns. If you don't show us that your investments are 80% equity, then you don't fall within our ambit. So who then regulates us? Okay. They have told us before, and I'm not pointing fingers or anything, but we have had before and said, maybe you go and become a money lender. And we sometimes we have, David is here, he knows we recently had to go and get a money lender's license because of what's happening. People run to court and say, you're not licensed, who licenses you? Capital Markets Authority says, we won't license you. We say we're not a money lender, so you invest and you're at risk of a smart lawyer saying you're doing this illegally. because you don't have a license. But I've tried to do it legally, but I can't. No one is willing to listen to me. So I'll go and become a money lender with all the restrictions, with all the things I do not want, but I don't want to risk the investments, and I don't want to risk my shareholders. So we could speak half a day and list one by one the challenges we have, right from fundraising all the way to the investments, investee behavior and all that, and it really could take even a day. But we are lucky and glad that it's starting to open up. CMA is starting to ask questions. There are reports being prepared. Fiona is leading on that. And we know it's going to take some time, but we have started moving. We are not in the 1% other that Kim mentioned anymore.
Thanks, Dennis. Actually, I just want to point out one thing that you've alluded to that reminds me, and since we have such a diverse audience in the room, it's important to flag it here. One of the biggest problems we have, I think, within our regulators, within our parliament, and within the people who are creating the environment for investment is a strong desire to overprescribe without any, I don't know why. Even now, as we are trying to make amendments, I keep, when we give feedback as an industry, we keep saying, look, make it broader, because, hedge funds may come in or etc. But there's still a desire to overprescribe. Why should you define what a venture capital vehicle is? And in defining it and not defining a private equity vehicle, what does that then mean? I need to become a venture capital vehicle to be here? Like you said about prescribing how much should be equity or debt. The first time I saw that, it baffled me. Because why is it the regulator's decision to decide what instruments a vehicle could have? So really, as an industry, as we go forward, we should try to remember that creating an enabling environment as a regulator is to not step back. You're not the operator. You don't know what your law should be dynamic for today and the future, right? You don't know what vehicles are coming in. You should just be able to make sure that whatever falls within your industry, that you can regulate it as and when it arises. Thank you.
Thanks, Dennis. Thanks, Kim. I want to move to Fiona. And the picture presented now is of doom and gloom. But I want you to present the picture of hope in terms of the work you're working on with the East African Venture Capital Association and the EU on the amendment to the Partnership Act and the regulations, and sharing from the perspective of what have been identified as the challenges and pitfalls. So over to you, Fiona.
Thank you, Stephen, Kim and Ota. Those were really interesting submissions. Ladies, gentlemen, good afternoon. And thank you so much for giving us your time. For me, it's a real pleasure to be sitting up here to share, but also really, really looking forward to just learning from you, engaging. So already hearing what Kim and Ota, as we've been told, is called, it's quite humbling, because as Stephen has said, the assignment that's been given to us by the East African Venture Capitals Association is really to analyze legal regulatory status right now when it comes to private equity. Are we encouraging it or not when it comes to the law? So a lot of the time you could get taken up with really just legalese. So hearing the actual feel of the law by a practitioner like Kim, it's quite humbling, but also really insightful in terms of really where we should be heading. So in some ways, listening, I was thinking to myself, I wonder if there's anyone from CMA here who could share some context on some of these prescriptions, because indeed they're quite funny, hilarious as you apply them. You're thinking, why? What was the thinking? It can't just be random. What were they thinking? Help us get to some middle ground, because from a client's perspective, in my case, a client would be somebody like Kim, it really is just baffling indeed. But anyway, so on to maybe hope. I don't know if it's really hope, and it's for us in this room really to determine whether indeed we're making positive steps. But I'm just going to pick up from what Ota and Kim have sort of shared as, challenges as we see them. Now, of course, I'm trying to wear the hat of both a lawyer, but also one of a practitioner of a real fund operating here, which is Kim. And please interject if you feel I'm going off the side. The struggles we've really seen, the hiccups, the pitfalls in our law, in our regulatory or policy environment here, have largely been around, the structure. A couple of things, but I'll mention maybe 5 that we think are quite big. And then, of course, we can sort of peel them like an onion and really get to the middle. A big one has already been mentioned. It's, when you're a private equity investor that really wants to be locally domiciled, do you go the corporate route, which is setting up a company, or do you go the partnership route, which is set up an LLP, a limited liability partnership? Which one affords you the best protection? Of course, if you're looking to put money in Uganda, you're looking to see the most tax efficient vehicle. Is it going to be that company, which, as Kim is saying, is probably going to be taxed, I don't know, 60 to 70%, you said, right? And yet corporate tax is 30 if you just start there. But then there'll be all these withholding taxes, like 6 to 15% if you're a non-resident, depending. There's all the withholding tax, there's VAT, so much that's literally sucked into tax. But anyway, so back to just the vehicle. If you are a fund and you have all this money and you think there's all these priority sectors to put money and actually add value, right? There might be a capitalist intention, but there's also maybe a social one, you're looking to improve the health sector and you want to know how to house this money. Are you going the corporate route? Because for now, it looks like the Capital Markets Authority only seems to recognize and want to regulate those funds that are housed in a corporate, i.e. you're a company. The capital market, so I don't want to get so legalistic and go into like definitions and all of that, but currently, Capital Markets Authority basically says if you're a venture capital fund, you need to be registered with the Capital Markets Authority and you need to be a company. Capital Markets Authority doesn't see the partnerships as houses or structures that can be used by funds to do business in Uganda. That's quite limiting. Why? Because when you do like a comparative analysis across Africa, different countries or hubs that are known to encourage and enhance private equity, these are largely going to be partnerships. Why? Because tax-wise, it's considered most tax efficient, but also the way partnerships would typically work, like limited liability partnerships, is you sort of go in, do something together, and then when that has ended, you effectively dissolve. Then you start again another fund like that. And that fund, when it's done the investing it needed to do, it will say, okay, we're done, this partnership goes away. We start another fund like that. Now, if you go the corporate route, which is a company, the winding up becomes a whole issue because, my goodness, it's so long-winded. There are all these notifications you have to do, all these days you have to wait after you put things in the papers. No one really wants to go in the papers to say, oh, this fund, we're done, or we have no creditors. It's so long-winded. No investor wants to come and be dragged through a whole long winding up process. They would rather just do the quick dissolution of a partnership. Anyway, so in terms of structure, there's still that question of if I'm a company, then I go under CMA. When I'm a partnership, okay, am I regulated, am I not? If I put all of this money here, will tomorrow somebody come on my door and say, you're not licensed, and yet you're actually doing this kind of business, you need to be here. So that kind of uncertainty is a major concern for investors in the private equity space, but also the fact that private equity isn't only venture capital. So is the CMA going to open up its definition to say, actually, we're changing now. If you're doing any sort of venture capital, if you're doing any private equity, any sort of hybrid where you're raising money, come, let me regulate you. So while CMA is still sorting that one out, to see if they can widen their definition to allow, I guess, trusts, to allow other sort of vehicles to still participate. On the other hand, on the on the partnership side, there's some work being done to say, okay, we realize CMA only focused on a company, so we've amended our Partnership Act, which had been around since like the 1950s, to actually say now we're catering for something called a limited liability partnership. Before, all we had was just a partnership. All of you, when you rise, you rise. All of you, when you fall, you fall. What has been introduced is the concept of limited, meaning you can be a limited partner in this partnership or you can be a general partner. General partner, you're liable for everything. Limited, you're liable to the extent of your contribution. What that means is effectively, if you're falling, you'll only fall to the extent of your contribution, initial contribution. There's some sort of protection there. Not all manner of debt is coming to you, right? It's the general partner. But the problem with that, again, is the fact that depending on how you've structured your limited liability partnership, you can be considered to be a general partner in there because of meddling in management of the partnership. So we don't have a very clear definition of what is managing a partnership. Depending on what you do on a day-to-day, if you're hands-off, yeah, you can be that limited liability partner who, when the burdens and the risks and the liabilities are slapped on you, you basically waive the fact that you have limited liability, right? And it's only the general partners that get. Now, when you think about investors that are looking to put money, they want absolute assurance that actually they are limited, that the liability to them is limited, that they're not thrown under the bus wholesale, that there's a limit to their liability. This is not very clear, but it's still a step in the right direction, that a law that's been around decades, it's even older than many of us in this room, has at least been amended to cater for a vehicle that many partnerships that we've seen in the Cayman Islands, in Singapore, in Kenya, in Nigeria, South Africa, have adopted, right? Even here in Uganda, I think to a certain extent, Kim, in Inua is a partnership too, no? Or you didn't go that way? Okay. So Kim's is a company, but we've seen provision in our laws that's basically allowing for a partnership as well, and therefore creating options. So when the investor comes in, there's not just the company, there's the partnership, and you just need to analyze which way you're going and the pitfalls under each regime. But having said that, always watching out for the fact that both under the company, you're going to be regulated. Also under the partnership, you're regulated, my goodness. And that's the over-prescriptive, the layers that then inhibit investment. Because previously, if you're a private equity investor, it's really contractual. You didn't really need to be looked at by anyone. But we've now got draft regulations that have been issued by the Capital Markets Authority that talk about the fact that if you're bringing in money, if you're going to raise any sort of capital, we want to know you. The Capital Markets Authority wants to know you and approve you. It wants to know where you're getting this money. Are you just whitewashing? Are you laundering? You're very generous in bringing the money to boost or to pump into a particular sector that might be struggling. I don't know, it might be a school, and the private equity investor is so passionate about improving education in a certain district or section of Uganda, but is that money really legit? So from a regulatory perspective, you can understand that's what they want to see. They want to know if money coming in is really okay, honest. Historically, really you just needed to come in and say, I like what you're doing, you university. I like the fact that you're doing a good job in this part of Uganda that doesn't have a lot. And I think there's also a huge market. Many people would actually want to go to tertiary school, have tertiary in this. So let me support you, let me put money in you. And it was all contractual. Now there's a big question there, particularly, you may have seen in the media a couple of questions there around who authorized you to lend here in Uganda like this. So yeah, away from structure, we have things like, the deregistration that I talked about earlier. When you're exiting the market, how do you do that? Under the Companies Act, if you're going to be a venture capital fund, which is prescribed as a company, that's a long journey. You're basically going to have to wind up that company. Winding up doesn't normally sit well with private equity funds because literally they're set up for a particular purpose, and when the fund has performed that purpose, you should be able to walk away and tell the regulator that, look, I've done this, I've made a margin, I don't have any creditors, I don't owe anyone anything, so allow me to dissolve and walk away. But actually, they want to first drag you through a very long-winded process as well. And for them, it's just about making sure that the public is protected. They just want to make sure you're not going to close shop and disappear when you owe anyone something, money. But the upside, I guess, when we look at context, it's really just to make sure the public is safe. I think that's where the regulator is coming from. On the tax side, which is really complicated, we see that the law has tried to make provision for limited liability partnerships to say, okay, a fund can be set up in Uganda with all these investors, maybe local investors, but also international investors. Now, when you come in, indeed, you're not going to have that corporate tax, right? Even if you've been asked to register and you sort of have corporate status, you're not taxed as a corporation. So the 30% corporate tax doesn't apply to the partnership. The individual partners will be taxed. But notwithstanding that, is the fact that if you've come in as a limited liability partnership, our law currently, the income tax laws or the tax laws, do not recognize the fact that there should be some difference in the tax, in how tax is levied on limited liability partners and the general partners. Instead, it's just bandwagon. As long as you're a partner in a partnership, right, and you've earned a certain amount, depending on what you've earned, the Income Tax Act basically has these thresholds. It could be 30, it could be 40. Typically, you're going to be in the 40 bracket because you make over, I think, 9 million a month, if it comes down to that sort of calculation. Then on top of that, there's the withholding tax just on a dividend. Then on top of that, we have the CGT. There's currently a proposal to do away with capital gains tax. And that might be good because capital gains means any day you're exiting as a private equity investor, and therefore you're disposing an asset, which would be your shares, maybe. There's a 30% tax there. There's a provision that says that if you have reinvested what you earned as you exit, 50% of what you earned within a year, then you're waived, CGT is waived. In practice, that has sort of not gone too well because as long as you involve the URA to do the calcs with you, they might just want to do a full-on audit to actually understand, analyze the full numbers, and maybe not many people in this room want that. So the change now is capital gains tax is being done away with. There's a proposal. And in its place, there's a withholding tax that then would be at 6%. That is yet to be debated. I mean, 30 and 6% is quite big, but it would be really positive for people in the private equity, in the alternative financing space. So let's see where that goes. Overall, we basically have seen, having done a comparative analysis with other jurisdictions where private equity really is blossomed and doing really well, there needs to be certain tax incentives, sort of adopted, particularly for investments in priority sectors, as they will label them in, countries like Uganda. Then it would be nice that there's some exemptions or incentives to actually invest in certain sectors, or just the fact that you're a private equity investor, that you're giving money into the country to encourage you to say, okay, for you, there'll be a reduced tax on your income, or a reduced withholding tax on this, or VAT won't apply on that. So there's some push to basically get some preferential tax regime for, investment capital, for money coming to the country that's really, particularly for social impact investors. In the private equity space, where really this is just to encourage money to come in and build and pump up the economy. I feel I'm talking too much. I'm not sure if I still have everyone with me, so I think I'll pause there. Yeah, thanks.
Thanks, Fiona. And I want you to remember the word that Ota mentioned, the smart lawyer. So all this has not stopped foreign domiciled funds from investing in Uganda. Now, the second part of our conversation, I want you to store the questions for the first part on domiciling and move to enforcement of rights. So Ota mentioned the smart lawyer. He also mentioned that at one point you have to register as a money lender with its attendant obligations. And so the question people are asking is whether Uganda is actually an investment destination for PE funds. If I was to deploy money here, would I recover that money afterwards? And there have been many court cases that have come out that I think have cast a picture of you may not actually recover your money in Uganda. So I want to begin with Ota, who mentioned the smart lawyer. What would a smart lawyer do to ensure that you protect your the fund or the investor, and make sure that at the point of default, which happens, the investor is able to recover their money in Uganda, in terms of due diligence, structuring, the agreements, etc., and from a practical perspective, what has been learned in the market. So over to you, Ota.
Thank you, Stephen. I'm hoping the smart lawyer I talked about before is not here, because then we don't want them to learn our tricks and find further ways of undoing them. So we're seeing a lot of change in the way investments are being done, especially after the Vantage case. We are having deeper, much deeper due diligence conducted. Now, the negative about the due diligence is the cost. So where due diligence was being emphasized towards the business, carry out a due diligence on the business, we're seeing venture capital funds, private equity funds, asking for deeper legal due diligence. Some, we've seen 2 or 3 who have actually asked us to carry out a due diligence on the investees' lawyers and how they operate. Cases they've handled before, how they think, what's their line of thought. Are they the kind that are going to go all out and fail the investment possibly fail the investment to the benefit of their client, or are they straight-up lawyers who understand the commercial aspects of business? So we're having deeper due diligences that firstly take time. Already conducting due diligence, pre-investment due diligence can be anywhere between 3 to 6 months. Now you're having delayed deployment of capital because the due diligence is taking 8 months. And the reports and the questions, and we're having failing investments because the risk profile for Ugandan investments has been heightened, and you find the investor saying, this is what I've found, and because of what I've found, I'm placing my interest rates higher than normal for Uganda. Already recovery for most impact funds in Uganda, which are really impact-based. Social impact funds are extremely rarely profitable because of faster taxes that Kim spoke about. But then finding the balance between social impact and return is really tough because of the pointers you're looking at. What is success for you? So we're already having that challenge that the SMEs that have impact are not very profitable. They're not being handled the best way they could. But then you have also the risk profile being heightened by these issues. And then you find investors saying, 9% is too low because of what I've found and what I know about Uganda. 12%, but 12% is the same rate as some commercial banks. So how is this alternative financing? The other thing that we're seeing quite commonly and that we have advised is investment through offshore entities. So we have an SME here, the business is being done here, everything is handled here, but the investor says, I'll give you 12% if I invest in Uganda. If you set up in Delaware, I'll give you at 6%. So there they are looking to cover change in the law. These court cases we're seeing, because the borrower, for all purposes, is the Delaware entity that's regulated by UK law, American law, or somewhere in Mauritius. But the capital eventually comes back to Uganda, but payment obligations are owed by the Delaware entity, meaning vantage happens, it happens to the Ugandan entity, but the obligations to repay still attached to the Delaware entity. Now, the shareholders in the Delaware entity are the individuals that own the Ugandan entity. Then the Delaware entity will eventually hold shares in the Ugandan entity fully. So if the law in Uganda changes, it does not affect the facility extended in Delaware, but the Delaware entity is a shell. So we have had such a scenario where it's a shell, there's not much, the money is being channeled from the Ugandan entity to the Delaware entity, which then pays. So if Uganda is not working, there's a default or something, you end up bankrupting the Delaware entity, but then there are mechanisms in the US, in that state, that says, okay, this entity is bankrupt, you write it off, claim a tax credit, so you don't lose, you're not at the pity or the mercy of Ugandan courts, Ugandan law, and that's working, but you see that it's taking jobs away from Uganda. There's so much that's not coming to the country, but at investor level, they're protected, they're comfortable, and they're willing to deploy capital at interest rates that are much less. We are having investors insist on personal guarantees, obligations taken up by the shareholders, by the directors, personally, that if there's a change in law that leads to failure of the facility, then you're personally liable for the facility. And we are having personal guarantees issued regulated by foreign jurisdictions. So we say a director is Ugandan, but they submit to foreign law governed guarantees as backup, that if the facility fails by any chance, someone says, I signed by mistake in Uganda, then they cannot say the same for Kenya, for Mauritius. So personal guarantees taken at different levels to also mostly impact investor decisions, and you have something to hold against them. Because if the mortgage fails, the share pledge fails, surely the personal guarantee won't fail, and you're able to shape them, line them where you want them to go, meet your conditions precedent, and the kind of business that you invested in remains. So these are some of the things that we're seeing come through. We are waiting to see how the smart lawyer challenges these things, but as they challenge, we also innovate. Thank you.
Thank you, Ota. Kim, you want to go next? Yeah.
Just to sort of piggybacking on what Ota's shared, we should ask ourselves as this room, what do we take away from what he's saying? Because for me, this is exactly the problem. From what he's saying is that basically we as a country are increasingly becoming investor hostile. With the proliferation of poor precedents, with everything that has happened over the last, 5 to 6 years in the financial services sector, and now we are seeing with private equity investors, what is the net effect on us, on you, on me? The net effect on us is that more and more of yourselves, your companies, your relatives are getting less and less access to capital because you're scaring local and foreign investors away from investing here because they don't feel protected, number one. Number two, the risk and the cost of your capital is going up even more. The whole problem that you complain about, or we complain about as a country, is that banking is so expensive. Why should I get 24% interest rate? You have these alternative vehicles that come in that attempt to give a slightly concessional rate to be able to drive development, and you create an environment that increases their risk so much so that either they have to charge you even more than that rate that you're running away from, or make you domicile externally just to lend to you at that concessional rate. And then the third thing is that these are jobs and profits flying out the country. For every entity that is domiciled in Mauritius, if I get an SME of mine and say, domicile in Mauritius, and I will happily reduce my rate by 10%, which I could do. What does that mean? What it means for Mauritius is that the directors are going to be Mauritian and earn money there. All the money, the tax, everything is to the benefit of Mauritius at the expense of Uganda. So I think that one thing that we really have to take away as a country, and particularly as the people who are in the space of alternative investments, is to understand our responsibility in creating and supporting an environment that is pro-progress, right? How do we as individuals, as people in our different sectors, as lawyers or whatever, advocate to make sure that access to capital in Uganda does not reduce for the private sector but increases? For example, the CMA, and what Fiona said is absolutely true. Why it is a very painful chicken and egg problem that the CMA is very prescriptive is because the CMA is there to protect us, right? We are the people that Fiona is saying that the CMA is to protect. They're local, foreign, they're investors. People who are putting their capital and their hard-earned money into the economy. If it is very prescriptive that I need to put 80% in equity, yet actually the way that I'm protecting myself is to say, I can't write the whole check in equity because at the time of exit, maybe the law has changed, maybe the person's smart lawyer is going to change the situation. So I'm going to structure it such that over time it liquidates a little bit like a debt. So I'm going to structure it as an instrument that is a convertible note or whatnot. So at 50% of it liquidates over time, and only 50% of it is at risk at point X. If I attempt to do that, and then the CMA says, no, you can't do that, because if you're not 80% equity, then you're not really one of the people who we regulate, so now you're on your own. The kind of investors we have don't want to operate. You know, the funny thing with having a good investor is that they want to be regulated. They don't want to invest in a lacuna, to not have the protection of the CMA. So it's very important for us as the room to understand that actually these small decisions, and something like the Vantage case, it is going to have repercussions in our economy for many decades to come. Because every investor, local and global, who looks at it is going to make decisions based on the fact that they believe that the courts can't protect you, that the structure can't protect you, that being unregulated can't protect you, and so on. So we have a very deep responsibility to effect the changes necessary, not even for foreign, but even for our own local investment vehicles, investment funds, retirement benefit schemes, to be able to invest their capital in Uganda in a protected manner.
Fiona, I want you to address something around arbitration and other protection mechanisms.
Sure. And ahead of that, I just had a burning point, and you raised it first. You basically said, look, we're talking about local domiciliation. No one has touched foreign, right? Which is really, really a big point. That while we're trying to encourage local domiciliation, encourage local raising of capital, we're not putting any sort of limitations on the foreign capital coming in or on what they must do when they come in. And it's easier to raise this capital in Mauritius, in markets that are a lot more advanced and more sophisticated and have all these spaces, environments that encourage, raising capital without too much work. So imagine if it's easier to raise in Mauritius, why would I come to Uganda where before I raise, I need to first figure out whether I'll have to be a company or a partnership, right? Then on top of that, our law here is basically saying, if you want to raise locally, if you want to be a local domiciled, I want to know you and I want to regulate you, me, the CMA. It's not saying if you're foreign, I want to know you. It's basically saying if you're raising in Uganda, so you can raise elsewhere, then come and invest, right? Those will be the contractual investments we're talking about. So then you wonder, in terms of competition, when it's a bit stiff and not encouraging in Uganda, whether there's going to be a lot of locally domiciled funds, whether we're actually improving. But anyway, having said that, we do have the foreign funds basically flourishing wherever they are and still bringing in the money here. And the way I've seen them protected in our practice is effectively you, the lawyer on the transaction, you're asked to give a legal opinion that before they disburse that money, all the bolts and the nuts have been tightened on this transaction, on this lending, right? So Ota was talking about, he's saying how they're asking the SME to, directors or shareholders to give personal guarantees, all of these smart ways, right? To make sure that this investor is putting his money and he'll get a return if there's changes in law or strange policy in your country that suddenly impacts his return. What I've seen is really a legal opinion, and when, as a lawyer, you're asked for this opinion, you really, you sweat a bit and make sure that the paperwork you're putting together actually is covering them, that they're not going to come back in 5, 6, 7 years and they'll point at you saying, you're the one who told us we could put all of this money. Yeah, now look what's happening here. So legal opinions seem to be a popular mechanism as well, that based on your name, you, Dentons, we're going to put in this money because you've told us it's safe and relatively this law is not going to change soon, kind of, yeah. I think on the arbitration side, on the litigation, going to court, unfortunately, I think we've seen investors having to go to court, and it's a bit sad. It doesn't paint Uganda in a very good light. Not many people want to come and lend and then have to fight and be questioned whether they actually had status to lend in the beginning. And then, of course, it would unwind a lot of lendings in the market, totally unravel a lot, because so many people are actually sitting on loans that are not necessarily from Ugandans or Ugandan licensed. So Kim is saying most of the government loans really are not coming, locally and not sourced locally. So a lot would unravel, but we still wait to see what the court will ultimately decide. As you may know, those decisions, with Vantage and Hamchigund are still on appeal. And of course, as lawyers, we're constrained from sort of discussing or saying what our personal thoughts are around what the judges have so far said. But having said that, I think we like to think that we have a fairly decent court system in place. There is a structure. Yes, it might take forever. Yes, it might be really, really frustrating. But eventually, you get through. So the mechanisms are there. If the right terms were put in this agreement to cover the investor, I really don't see why they would be, typically they would be enforced fairly. And there's always mechanisms to sort of appeal. It's just about being patient. But eventually you do get there, where it's very clear that I lent you money and we agreed this is how you pay it back and you've defaulted. It's black and white, it's ink, it's on paper. The law will respect that, the court will respect that. Court typically will not deal with people that sort of are coming to justice with dirty hands. I know most of you are probably looking and saying, our court system, which is so flawed and you can sort of influence here and there. By and large, it does work. It's a real structure that does work. Unfortunately, some of us do compromise it every so often, but by and large, it does work and can be trusted. Yeah, thanks.
And add something, Dennis?
Just one more bit that came to me as Fiona and Kim were speaking. Some of the other things that we're seeing, a preference to take equity instead of debt, because where we've had court decisions saying you're not allowed to lend here because you're not registered here, you're not regulated here, it's very unlikely that a court is going to say you're not allowed to buy shares in a company in Uganda because you're not registered here or regulated here. Shares are property, you can own them whenever you like. The challenge with that is that you have a working capital need, refinancing need, machinery need of, say, $2 million. Most of these bigger private equity funds have ticket sizes of $3 million and above. So if they're going to invest in you for $3.5 million, and they rarely take more than 66% equity, so let's go with 50%. So if I give you $3.5 million at 50%, which is also very rare, we are seeing 20, 30, 22, 27, that means you have to have a business book valuation of, say, $8 million, $9 million. That's rare to find with an SME, or the businesses that actually need the capital, that are not banked, that are not commercial bank financed. So what then happens is that because the valuation doesn't match up, the investor is not able to extend the 3.5 million, so they will back away. If it was debt, on the other hand, then they can freely invest because there's a repayment that's coming. It doesn't have to be matched against the book value of the company. You've got to provide security, valuation is done, and the security, whether it's personal guarantees or personal property, has the value to cover this facility, and it's a facility. They lend you, you repay. But because that exposure for out of the Hamis Chigundu case and Vantage is not something the investor wants to go down the road, they go equity, and they'll offer you need $3 million, they have a valuation and offer you 1.5 million, 1 million, and they say, maybe go to commercial bank and get more money. So they're not helping, they're withholding capital. They want to deploy it, but they can't deploy it as debt because they have been told that in Uganda, you lend today, and tomorrow they'll tell you your facility is illegal, goodbye. So we have tried to see how to help and cover, but they all come with different challenges that are affecting this space.
Yes, Kim. It's on.
Sorry, I just wanted to end on a different note from how we've discussed, or how I have discussed, which is that, and it circles back to where I began. For the first time, maybe in 14 years, I feel a sense of optimism in our industry. For the first time, and this is really over the last 2 years or so, for the first time in that period, I really see, in our case as equity players, a regulator that is doing everything that it possibly can to make the changes that need to be made. The real problem that we had for the decade before this was the fact that the industry cannot act alone. And when the industry attempts to speak, everyone assumes you want to evade taxes, everyone assumes that you have some agenda. So I really just wanted to end by saying that I'm really grateful to the Capital Markets Authority for the work that it has done in the last 3 years to bring us together, to attempt to ask the right questions and to ask how it can change. I'm extremely grateful equally to the East Africa Venture Capital Association and the pioneer PE firms that have helped prop it up in Pearl Capital, XSML, and Ascent Capital, that has done a lot of hard work and paid a lot of bills to try to get the community to have these conversations and to progress them. I'm particularly personally grateful because, as I've really alluded to, when I attempted to do it alone, I was a complete failure. So to see the kind of work that we have, to see that the IAFCA has marks on the case, to see the amount of, we are recently regulated by the CMA, and to see how much they're doing to try to make sure that we can operate even within their own restrictions is the saving grace. And equally, just like Fiona said also about the courts, so many times we have so many cases in court that are not going well, that we know very publicly. But there are so many actually that have also gone quite well and gone quite swiftly. And without that kind of public cooperation and without us selling those success stories to other investors, we will not see the future that Uganda deserves. So thank you very much.
Thanks, Kim. On that good note, allow me to open it up for Q&A. We can take a round of questions and then answer them. Yeah, so Sania.
Gentlemen, ladies, thank you very much for your presentations and contributions. Just for the record, and I'll speak for and on behalf of Mr. Kalijira, CEO, Capital Markets Authority. I think in his earlier remarks, he alluded to the fact that the Mother Act, Capital Markets Authorities Act, is currently being reviewed. And part of the review involves private equity. And the idea is basically to remove the restrictions on the legal structure. I think currently it's the corporate structure, but I think the idea is to open it up to partnerships, collective investments, and at the same time remove the prescription on equity as well as debt. Then secondly, we currently have draft licensing regulations, and those draft licensing regulations also speak to the idea of creating a facilitative licensing framework for private capital funds. So there is some traction in that area, and the beauty is that IAVCA was actually part of, that's the East African Venture Capital Association, was part of all those discussions that culminated in a new definition, as well as the provisions in the draft licensing regulations that pertain to private capital funds. So I think there's progress, yes. The progress is not as fast as probably stakeholders would want to see, but I think there is movement towards making right what has not really worked over the last couple of years. Now, speaking to the thinking behind the current definition, I cannot even explain the thinking behind that. But the thing is, we've realized where the defect is, and we're trying to cure that particular defect within the existing legal regulatory framework. But then, that said, I still believe curing that definition is not the silver bullet in as far as the private equity space in Uganda is concerned. I think the whole ecosystem has to be looked at broadly. I think curing that defective definition is just one piece in the jigsaw puzzle. I think we've talked about contract enforcement. There's so many other aspects within the ecosystem that need to be looked at thoroughly. I think Fiona talked about the Partnership Act, which we're also part of. We're part of that particular initiative in trying to basically identify why we've not seen local domiciliation of funds in spite of limited liability partnership provisions existing within the Partnership Act. So I think we need to have a broad view. We need to look at all the issues in entirety and look at the entire ecosystem. So I wish to, yeah.
Thank you. There was a hand at the back. So I think it's just a comment.
So thanks for the presentations up there. My name is Busula Bernard, and I work for the South African newspaper. Just two questions. One to Kim. You spoke about the high tax burden that a private equity investor has to deal with, but the reality is, any developing country that is able to collect taxes that are worth less than 20% of its GDP and has a huge fiscal deficit, we need to collect more taxes, and the fact that to ask for more from all of us is inevitable. So the question is, what would be the more favorable tax exposure rate for a private equity investor that walks into your office and wants to do business in this country? And then to Stephen Messenger, I mean, you spoke about the vagaries of lending money to local businesses and then getting short change, which happens to most of us. But I need to understand. There are few legal precedents in our court system which actually indicate that you lending money to me, it doesn't mean that I have a right not to pay you, so because you are not registered as a money lender or financial institution. But the courts say any equity argument can be enforced for as long as the interest rate is less than 3% per month. So that's the kind of advice some of us are getting from your land friends in the boardrooms where we sit. So the question is, what comfort does that give to a private investor trying to lend money to a risky Ugandan business? Thank you.
Let's start on.
Over to you.
Are there more questions? We wait? Okay.
Yeah, let's take a round and then we answer all of them at once.
Just one last one.
Yes. I think there's two more. There's two here.
Okay, but
Yeah.
Thank you so much. Yes, thank you so much, Kim, Fiona, and Otta. When we were coming here, we were also coming as deployers of capital because we are fund managers. And the first question we always asked, or if you want, the first question you asked when you enter a meeting, within the first 5 minutes, is give a high-level summary, and the return that you've given has to be explained and backed up. So the truth is we are looking for opportunities that can diversify our product offering. That's the truth, and that's actually why I'm here. One of the things I want to thank you so much, especially Kim, is that you have been brutally honest. I don't know that say extremely honest, but I've realized that the private equity space has more issues that need to be dealt with than I actually knew. Now that's information I was not aware of, because I've been hearing about a hostile environment, due diligence taking 6 to 8 months, taxes being so high. Now, for the kind of clients that we invest for, how would I convince them? Because you even gave an example of $100,000 barely making $10,000. You actually realistically said it's as low as close to $1,000. So now, if an investor gave me $100,000, kindly help me explain to them why we should invest in private equity. Do you honestly believe that maybe this is an asset class that requires extremely patient capital, and that fund managers like us, maybe this would be an investment class which is still ahead of its time? Kindly help me understand that, and then I will be able to give correct information. Thank you.
Thank you. There was another hand, I think, here.
Okay.
And then we can close the conversation with responses.
Thank you very much. I just want to comment on my brother here that what he's saying is that he's happy investing in government bonds, doesn't want to deal with private equity, but that is for the panelists. I wanted to say that from information available, it is the US that has the biggest funds globally, followed, I think, by some developing countries in the West. For us as Africa and Uganda in particular, we are still growing. So in terms of regulation and where we are on the growth path, are we at a level of the appropriate regulation given our level of development, and which of the laws present the gap that would alternatively provide the opportunity that the funds would be looking for? So I think we need to go back and study properly the growth of private equity in various markets across the globe and determine where we are as a country, given our level of development, given the way we operate in economies where the governments, not just individuals, but even the governments are still operating cash budgets, plus the high tax levels and all the constraints that come with that in terms of creating value. And then when you are discussing, I was also thinking that maybe we are looked at Uganda and maybe East Africa, we are looked at as an alternative investment for other markets. So while we are discussing and looking for alternative investments in Uganda, others look at Uganda as an alternative investment. Maybe we need to think seriously about that. And then last but not least, in terms of policy growth and in terms of regulation, maybe we need to work more as East Africa, and it's good that we have the CFA Society of East Africa. We need to work more as East Africa in terms of developing appropriate regulation for the markets. Thank you very much.
Thank you.
Over to you.
I think I'll begin where I started with Fiona, and then I'll come as we make your quick comments on the questions raised and also your concluding remarks in the interest of time. So over to you, Fiona.
Thank you, Stephen. I'll be quite fast. I'll just quickly run over them. CMA, thanks so much for the clarification you've given. Certainly a holistic view needs to be taken. I think one of the considerations you'd missed out was tax. A lot of investors are going to be driven largely by the tax. And is it efficient? What tax applies? The structures, yes, and all of these other registration hoops and loops, but tax is a big thing because it impacts what gets into the pocket at the end of the day. Let's see if the taxman will hear them out as well, because we've all heard how high the tax burden is. What comfort, this was for Kim, right? What comfort does the current, I don't know, in my notes I said the current Chigundu question, Chigundu being, the harm Chigundu case and advantage capital. What comfort do investors derive when they see that in terms of enforceability here? Of course, it shakes the confidence of both our local market, but also the regional global markets. No one wants to see an investor being dragged when all he did was honestly just negotiate a commercial agreement to lend you and get back his return. So it shakes. But the comfort he can get is that our systems work, for sure. The court works. The lawyers on either side will argue all manner of things, but at the end of the day, the contract is black and white, and it will be enforced, and they get enforced. Kim was just telling us that some are good, some you win, some you lose. You just pray that you're not losing on some technicality that on the face of it is just so unfair, but you do get to the end. Private equity as an investment class, is it worth it? Yeah, is it worth it to go private equity? Definitely, we're seeing it growing. Clearly, there must be something in it. T-bills, wonderful, nice and slow. But I think, Kim was talking about, 12 years ago, 15, when she came back to Uganda. I've been practicing about just under 20 years. Of those 20, maybe 12 in Uganda. And I think when I started here, private equity actually didn't exist. All these things of mergers and acquisitions, people coming in to put money in a company to turn it around, make it work, give it systems, give it governance, put a bit of capital and make it fly. That didn't quite exist. Now we're seeing it, it's like every single day there's something rolling in. Someone has identified an opportunity in an SME in Uganda. Yes, due diligence takes a bit of time. You have to be careful. You need to understand their operation, their thinking, their vision. Can you align? Will your money make a return? It's all necessary. And sometimes it might be faster, just depending on the mindset of the people you're investing in. If they absolutely see your value, I think they'll stop at nothing to show all their cards. But if they have to keep hiding, that's when things take a lot longer. But yeah, it certainly is worth it, and it's catching on. I think today we're seeing so much more. I mean, look, IAVCA, and by the way, I have to mention that IAVCA is working in partnership with IFAD, which is the International Fund for Agricultural Development. in basically pushing for this domiciliation of local private equity, the domiciliation of funds in Uganda, or at least the assignment we've received is from the two of them collaborating to see, change and to hear what the industry is saying about the current regulatory environment and how sufficient it is. So back to your question, is it worthwhile? We're seeing a lot of traction, so it must be. The numbers don't lie. Yeah, there's got to be something in there. It leads me then to, are we at the appropriate level of regulatory development for the investments that we're seeing? Are the investments at the appropriate level for the right regulation, for the regulator to step in and say, this is catching fire, I need to have a hand in it? I think we are. And I think that's why we're in this room, because suddenly private equity has really gained traction. So much money is coming in. We're now seeing these cases in court. So much money is being raised and brought to Uganda, and the regulator is starting to say, no, I want to be part of this conversation. So clearly that traction is attracting stakeholders to come in and say, what exactly is going on here? Yeah, what exactly? You're raising money, getting shares, buying securities, what's happening here? So yes, I think we're at the right level, and indeed I think we should cut ourselves some slack that as we grow, there will be teething issues, and what we're doing right now is to basically address them and to see how to guard and put the right, framework, adjust as we go along. We'll get there. I'm positive. Thanks.
Thanks, Fiona. In 1 or 2 minutes.
Sure, let me try to be fast. I'll start then with the issue, the fund manager saying, why should I invest in PE? Realistically, you have more issues than I even thought you had. True, we have a lot of issues. I don't want to hide that. But guess who has more issues than us? Listed equities. How are your listed equities doing? What are they averaging over the last 5 years, 10 years? The Nairobi Stock Exchange, the USC. So realistically, number one, we have seen from the macroeconomic environment over the last 18 months and the collapses of one sovereign country and a couple of the fixed income of one sovereign country, and with 3 others on watch, that actually your very high yielding government securities are not risk free. Number two, you cannot put 100% of your money in fixed income. In fact, we fought very hard in that stakeholder meeting to ensure that was the case, because everyone representing you guys wanted to have at least 100%, up to 100%. So for the 10% that you have to put elsewhere, this is where we come in. What are your alternatives? And when you look at the alternatives that you have at your disposal, particularly with the East African regulation, you don't have anything actually that's yielding even in the low teens at the moment on a consistent basis over a period of time. And if you look at private equity, our gross returns are very healthy. So you're looking at 25 to 30% return. So if we fix these environmental issues, the net return will be significant. And we are playing the long game. That's why the catalytic investors have invested in someone like us, for us to prove to you that over a 10-year period, we are doing low-teen returns, which is superior to your other alternative investment options at the moment. With respect to the CMA, thank you very much. I agree that curing the definition is not the be-all and end-all. It's just a piece in the jigsaw puzzle. All issues in their entirety need to be looked at. However, what I really want to say, the market is not, people are entrepreneurial, companies are entrepreneurial. The market is not expecting everything to be perfect. I will be very honest with you from a practitioner's point of view. If we cured the tax issue, and which has a little bit to do with the definition, the structure, the partnership, the tax issue is the biggest issue that makes it not viable to have a PE fund here. If that is cured, people will deal, there is a cost to doing business in every country because of their legacy regulatory issues and whatnot, and people are happy to bear that cost if it is reasonable. This is just something that is unreasonable, which comes to the question that was raised by the journalist. And because I have to be fast, we're going to do some math. Because I have to be fast, if you're genuinely interested in doing this math with me, maybe get a pen and paper, because what you're positing is not true. It sounds like it's true. You use all the right words. But when added together, they don't add up to a truth. Private equity firms are 100% comfortable to pay tax. In fact, I would be happy if the tax was higher. The tax rate is not the problem. The problem is fairness. What a private equity fund is trying to tell you is that the same income that we are earning is being taxed 3 to 4 times in each different tax bracket. we have no problem with the rate. Increase it if you want. What we are saying is that we should have the same tax rate as any other corporate firm. If I'm a limited liability firm and my taxable income is a 30% tax bracket, why should another limited liability firm have it at 86%? So what we are asking is recognition in the law and in regulation that the same income is being taxed multiple times. And when this happens in so many areas of the law all the time, and what the tax man says is, if we've already taxed this income, then this is a cap. Once you get to this number, then this is a cap. So number one, private equity, you were saying that, as a small country with less than 20% GDP and all the right words to make it look like the problem is this is helping broaden the tax base. This is actually helping narrow the tax base. Private equity firms on average invest in 30 businesses every 10 years. Because of the investors that we have, compliance with tax law is a must. When I invest in a business, and we're just having this conversation on that table before the panel started, when I invest in a business, on average, the year before I invested, that business either ran a tax deficit or paid less than 10 million Uganda shillings in tax. i.e., SMEs are not paying tax. And as you would know, as a tax expert, every country that is surviving off of its tax base is surviving off of the tax base being broad, i.e. SMEs taxes. What we do is within a year of investing in a business, on average, the businesses that we have invested in within 1 year have gone from paying either no tax or under 10 million in tax to over 100 million shillings in tax at a minimum in the first investment year and growing, because compliance for us is a non-negotiable. And growing the tax base is one of the key objectives of my fund. Take a look at our website. Therefore, if we invest in 30 businesses in 10 years and at a minimum annually increase them from paying no tax to 100 million in tax, we are increasing the tax base for URA just from our portfolio by 3 billion a year, which is far more than the tax that they are taxing us. So our existence broadens the tax base, and you will see from the history of investment vehicles and equity investment vehicles in every market in the world, that is exactly what we are doing. What we're trying to do is unleash tax, unleash jobs. That is literally the objective of my fund, is to do only those two things. Making a return for my investors is not even in the top 5, and those are the two most important things that we're trying to do: create jobs and create tax. So we are very comfortable to pay tax. Instead, and let's get to the math bit, what we are trying to explain to you is that for a fund like ours to exist and be able to pay its own bills, we have to have a tax number that is fair. Even if it were higher than other companies, which I don't understand why it should be, it cannot be 4 times or 3 times higher. So for example, if a fund like mine, a $10 million fund, is going to invest $500,000 in 20 companies over the next 10 years, okay, as pure math, and then we seek a gross return of 20%. So for every $500,000 we invest, let's say we make $100,000 as return on that business. That company makes the $100,000. In order to remit it to us, first it is taxed, corporate income tax in that company, right? So it goes down to 70K, which I'm even going to ignore and pretend it didn't go down. But imagine it's already taxed there for corporate income tax. But then that 100K is to be paid out to me. I pay capital gains tax of 30% on that 100,000. I further pay a 15% dividend tax to receive that money. When it arrives in my account, it's $55,000. From the 500,000 I invested, the return of 100K is $55,000. So that's a 45% tax exposure. Then, in my company, it's charged again, corporate income tax. But why? This income was already charged corporate income tax prior, but it pays 30% in corporate income tax. It becomes then from 55K to 40K. Then I have to pay it out to my shareholders because I am a company. They are further taxed, again, dividend tax. And if they are foreign, it is withheld, right? So over and above the 30% tax that they are charged to take it down from 40K to 23K, they're taxed another 15%. So you have, for this $100,000 that you made, you're receiving $23,000 as a return. Times the 20 businesses that you put it in, that's $460,000 as a return over your 10 years. But in order to run this fund of $10 million, I have my own costs, rent, lawyers, as you can hear clearly, they're not the cheapest, talent, and employees of $500K per year, right? Where I can tell you, I can open, in fact, we will be opening our books to you because we are regulated by the CMA. So we have $500K that we are spending every year for these 10 years. That's $5 million. And over those 10 years, we made $460K. How am I supposed to keep the lights on? I have only two options. Either to take the lights off and not domicile here, because if I domicile elsewhere, I will get a fair tax rate, or I push that rate and that cost to the SME. And suddenly I can't lend to them equity that looks for 20% return. I look for a 90% return. Then you say that I'm a money lender, the foreign people, they're trying to take money out of the country, when actually you are taxing this same income multiple times. And that is just simply a mathematical problem that URA can recognize and has already done in many other areas in terms of import, export, etc. And then set a cap and say, if this same dollar has been charged over 50% tax, that is the max. All right, so no one is arguing, private equity is not looking to make a buck. I'll be very clear with you, every SME fund, as Stephen alluded to, that sets up in Uganda, at best looks to cover its costs. They cannot make money. They cannot make money, they do it purely for impact. And so we are the ones who are losing out on the impact.
Thanks, Kim. Concluding thoughts, Dennis, and we conclude.
All right. Just a vote of thanks to everyone for attending, the panelists, but for just a small one for the CMA, because we see that they're here. The overprescription that has been repeated again and again. The question that came, is the regulation enough? Are we at par with the investment needs? The truth is, of course, the law is always going to be behind people. It's like trying to regulate technology. You're always going to play catch up. The nature of this capital is that it's creative capital. People are always creating solutions. You cannot regulate for everything. When you try, you stifle the investment. Better, you open it up. I'll give you an example. In South Africa, venture capital funds, private equity funds are not regulated. You regulate the fund manager, the person that makes the decision. You ask them to take out professional indemnity. They're personally liable for the decisions that are made, because at the end of the day, they're the ones going to sign the document and say, invest here. They're the ones going to ask the investees to do particular things. I'll give you an example. A law firm, you can't regulate a law firm because there are people in the law firm. So you regulate the people because the people make the decisions. The law firm doesn't. So if you say, and that's where the misinterpretation in the law with the Vantage case took the wrong side, took off the misinterpretation, because they're saying, oh, Vantage is not registered anywhere in the world, therefore it cannot work. Why not? The three of us can sit here and invest together. We have investment clubs. We sit, the three of us, we invest in an entity right there. But if we have a lot of money and we're not interested in running around, we get a fund manager, Pearl Capital, in your capital, and say, here, have our money, invest it for us. And they will invest it. You, the Capital Markets Authority, regulate that person that's investing, not me, the shareholder, not my company, because for us, let us be who we are. Let us sign an agreement saying we're investing in one entity. When that investment is done, we'll separate, go our own ways. And that's it. So you leave it open, because every time you overprescribe, you're going to miss something. So you're going to have an amendment every year, because something new is coming up every 6 months. You're playing catch up, yet you don't need to open it up. Let people bring in capital as they feel the need arises, and you see a real change. Thank you.
Thank you to my panel. A round of applause to my panel. And thank you to the CFA Institute, the CFA Society for organizing this. We look forward to these further conversations within the YAVCA and other places. And thank you for being a very good audience. Asante sana.
Yeah, special thanks to the panel. I think this has been the most passionate panel that we've had today. Yeah, special thanks to Fiona, Stephen, Kim, and Ota. I think I've seen Fiona at some of the CMA's workshops, and that's a good sign. Thank you very much, ladies and gentlemen, for sticking with us. We are nearly there, just one more panel, and well, this panel is going to be moderated by Reginald Tumusime. He's the entrepreneur, founder, and CEO of Capital Savvy. If there's one thing I know about Reginald, he's a very fit man. One of the good things with being fit is that he's going to manage this panel in a very sportsman way. To introduce the panel. It's a very good discussion. Someone said, I think it was, someone said that is Uganda an alternative investment? And you know, that's a thought. So let's continue that discussion, Reginald. Over to you.
Okay. Good evening, everyone. It's a pleasure to be here. So in the interest of time, I'll dive right into the panel. So we have Samir Somal, who is the CEO at Blue Ocean Global Technology. He's also the co-founder of Gal Power Talk. He'll be joining us virtually. No clap, can't clap. We have Chipiwa Mukono. She's the director of finance and investments at Blue Ocean Global Technology, who will also be joining us virtually. And then we've got Philip Kasatura. He's the country director at Catapult Africa VC. Thank you. And then you have myself, Reginald Tumsime. I'm a founder and CEO of Capital Savvy, and I'm happy to be here to moderate this panel. Okay. Okay, as we wait for Samir and Chipiwa to join online, allow me to start with you, Philip.
Hi.
Oh, fantastic. Hi, Samir.
Hi, Reginald. I think we are here online. I know we've had a little bit of delay in the schedule, so I just moved this other commitment. It's really a pleasure and honor to be here and contribute to this conference. That last session was truly memorable and insightful, and I really look forward to building relationships with all of you. Thank you for the opportunity to share perspective, and looking forward to learning from all the other panelists and offering context and guidance where appropriate.
Fantastic. Is Hi Mukono, is she there? Just say hello.
Yes, Reginald, how are you? Thank you for having me here. Looking forward to the discussion.
Fantastic. So I'll start with you, Samir. I know you have to leave in the next 30 minutes to join another engagement.
Reginald, I did, just because I was so excited about this conference, I did try to push that off a little bit. So I'm going to stay as long as I can, but thank you.
Okay, fantastic. I know throughout your work across the globe, you've had the opportunity to interact with a number of investors. I think the first question for me would be, what are their views about impact investing in Africa? Are they excited? Are they enthusiastic? Or are they as frustrated as the previous panel sort of alluded to?
Well, I think first and foremost, the world has changed. I mean, I'm someone who is particularly and acutely interested in the growth story in Africa. And I think you'll find that it's somewhat binary. I think people kind of tether themselves to an old world view where maybe they don't recognize, or they haven't done their own due diligence, or they haven't read enough about just how compelling it is in terms of Africa's rising middle class, the youth population, the growth of multiple economies, including that of Uganda. And then you have others that lift up the hood and see the growth story and recognize the trends, and they're wholeheartedly committed. So I think the story is still somewhat nascent in the global investor economy, but at the same time, more and more people are recognizing it. And it's incumbent upon those professionals who are here today, which is a big reason why I'm here, to foster relationships, to do good. And, as John D. Rockefeller once said, the next best thing, Reginald, to doing the right thing is telling people that you're doing the right thing. And I think as we uplift and leverage technology and find synergies in order to empower people and create value for investors, we have to also remember that we have to let people know about that story and amplify that.
Fantastic. Second question to you still, Samir, and this is from experience as well. I recently raised a fund for impact, but our focus is on debt because of the issues we've had around equity in this market. And one of the things we continue to struggle with in an era where we've got to communicate what this impact means to investors. And I know you're very passionate about telling stories, digitally especially. You've helped a number of companies to tell their stories. What do you think is the best media of communicating your success stories to investors in impact funds?
Well, Reginald, does everyone in the audience have a pillow and a sleeping bag? Because it's gonna be a long answer. Just kidding. I think the way that you think about how you approach telling your story is you have to think of it in the context of your digital reputation. And so if you look back 20, 30 years, the way that we found out about somebody was traditionally through newspaper, through television. And now if you look around the room at the audience, if you think about how you interact with your colleagues, your friends, investors, family, your children, your parents, our lives have moved online. And so we need to be thoughtful about what is the digital presence and how do we take the trust, goodwill, relationship capital, and the story of what we're doing with a particular company or how we've decided to invest, and how do we authentically represent that on the internet? Because as I oftentimes say to institutional investors or family offices at events, even if your best client that, let's just say, has a lot of money with you, $200 million, if they make a recommendation about working with you, they likely aren't going to call first. They're likely going to go to Google and they're going to research you. They're going to research the company name. And if they find information that allows them to foster trust and have a better understanding, that is going to be positive. So I just wanted to begin by framing that in terms of digital reputation. So what is your digital reputation? That's composed of all the information that somebody finds about you online. Your website, public relations, blogs, videos, of course, social media, podcasts, interviews. These different components, almost like the mosaic theory in finance, come together to tell a story. And I can give you, an example in my own life as a graduate of Georgetown University in Washington, D.C. I was interviewed by their alumni association, I think in 2013. And to this day, people mentioned that when they did a thorough research about me, they found that, hey, 10 years ago, I was speaking about how business alone is not enough and you need to drive impact. That also goes I do a lot of work with attorneys. I'm an expert witness in court cases. I consult with some of the most prominent law firms in the world, and quite familiar with Denton's as well. And I recently had a situation where there was a lawsuit with two major companies on intellectual property, and what the attorney said is, Samir, I know there was somebody else we were considering, and they'd probably done maybe twice as many cases as you, but I read about Girl Power Talk and the fact that you've created a social enterprise that is empowering women with opportunities in 25 plus countries. And that really resonated with our team. And we said that this is somebody we'd want to work with. And so who would have thought that something like that? So when you think about representing yourself, I don't think there's one, Reginald, particular medium. I think you need to be thoughtful about delineating that into digital assets and creating pillars that can support telling your story. There's been a number of studies. I mean, there's public relations firms that talk about, CEOs, 95% of them, I think it's from Burson Marsteller, say that corporate reputation plays an important or very important role in the achievement of business objectives, yet of that same group, I think less than 20% take action. And when you think about valuation, you think about a company, there's something called the dividend reputation report, and it's anywhere between 35 to 65, 70% of value, intangible value of a company is now tied up in its reputation. So that doesn't necessarily mean that, hey, you find somebody young and say, hey, they're handling our social media. As some of our clients, when we started working with them, they said that. I think the reputation and the way that you tell the story has to be an organizational-wide focus, and you have to have a real plan for it, and you have to be consistent in sharing information, not something every day, not even something every week, but making sure that you're documenting the progress, goodwill, the value and impact that you have across the board. And the last comment I'll make here is that it is a little bit overwhelming. How do you make a decision about what to do when you get to start? Do I spend money on digital ads? How do I consistently write content that's out there? Wait a minute, what about when you click on the images or the videos tab on Google? What is populating and showing up? Should I have a YouTube channel? So these are all questions that, because reputation has a tangible impact and contribution to valuation, are important. And also when you think about fostering the speed of trust, creating opportunities, and of course, mitigating reputation risk in the event that there's a crisis or something negative happens, I always frame it, be it at a keynote or be it working with a client directly, in terms of your digital reputation or digital presence.
Okay, thanks, Samir. I'll come back to you in a second. Philip, I know Catapult has been making very interesting investments in different companies, especially in the agriculture sector. Question: are there any other sectors you believe will be at the forefront of impact investing, across Africa in the next decade? And also, what do you think, as a country like Uganda, what do you think is our competitive advantage in those specific sectors? Where should you think we should spend a lot of time investing resources? Thank you.
Thanks, Reginald. And I do apologize to everyone. We are not going to stand between you and the evening, so we'll be quite quick. But I think from our experience, Catapult has been focused on ag, particularly tech. But we've seen the last couple of years, it has been financial inclusion. That's been the big one. But if you stop and think about it, I went to Makerere here many years ago before the border came. We used to take taxis. The two things that I think have grown the Ugandan economy are when Momo came and the border came. The fact that I can call someone in a rural area and pick up stuff and move things around. So we see mobility as one of the next frontiers where we're seeing more in terms of the investment in that space. And what you're tending to find right now, particularly in East Africa, is electric vehicles. Not yet the four-wheelers, but mainly in the two-wheelers is a space that we think there is a lot of investment coming in there. But The other area I'll point to is still energy access. In Uganda, we still only have 28 to 30% connected. And so there is still a huge potential in that space that we see, particularly driving the investment. And that's where I think is a lot of money impact will be flowing to.
Speaking of financial inclusion, Chipiwa, quick question for you. As a very passionate lady in the impact investing space, one of the things we've observed in Africa has been a constraint around financing, especially for women-led enterprises. But I also believe that there's a lot more challenges that women-led enterprises face. What are some of these that you've observed from your experience, and how can we leverage on the growth of impact funds in Africa to sort of help women-led enterprises grow? Thank you.
Thank you so much for that question, Reginald. Thank you so much, everyone, for your time and for this opportunity to learn and share with you. So in my view, with regards to women getting access to financing in sub-Saharan Africa, there is the mainstream view that we have supply-side constraints with high interest rates and a lot of structural issues in our financial systems that make it a bit more difficult for women to access finances for their businesses. But there is also a demand-side issue to it, which maybe gets discussed a little less than the supply side, which is where there's less consideration for women decision-making behaviors and how they play a key role in this gap in financing. So the African Development Bank did some research and found that women have been self-selecting out of certain financing opportunities and not applying for certain finances they can receive or lines of credit because they were discouraged by their own perceptions of what their credit worthiness was. So from my experience and my view, I think the first thing we have to do as a continent, as policymakers, as drivers of change, is to first educate women who run these enterprises and have them know what is available to them and why they should not hold back from reaching out for certain things. Because a lot of the time it's the lack of information that ends up with you having a wrong perception of what you should be able to have access to or what is possible and available to you. So the first thing, in my opinion, is to work on the financial literacy aspect of these women who run enterprises first. And from that education, we then position them to be in a place where they could reach out for some of these options available to them to grow their businesses. And then the other thing is we also do need to create products that account for behavioral differences in the way women approach risk and the way women approach financing their businesses. For instance, women are more likely, they've been found to be more likely to save informally than men, or to participate in informal circuits of accessing finances, of accessing funding for different things that they may be trying to achieve in their businesses. With that in consideration, it would make sense to tailor products specifically for this type of behavioral relationship with the financial markets, specifically with women in mind, in order to encourage a higher participation for them, which would eventually and hopefully translate into better business outcomes for enterprises run by them. Thank you.
Thank you. Samir, back to you. Two questions in one. The first is around impact reporting. One of the things as active impact investors we've observed is a lack of standard for impact reporting. What's your experience from where you sit across dealing with multiple companies in this space? Is there any generally accepted or agreed methodology to report impact? And also, I know there's been a lot of emerging technologies across the world. We recently saw ChatGPT, very interesting AI platform. what do you think are the key emerging technologies that Africa should look out for? And how does that relate to helping us attract impact funds as a continent and a country? Thank you.
Thank you, Reginald. Appreciate that. I think first and foremost, when you think about impact investing, you think about ESG, it still is a relatively nascent discipline, although it's gained, I would say, somewhat exponential prominence over the last 2 decades. But it's still relatively new. Also, what makes the reporting, I would say, a challenge with respect to standardization is that it's idiosyncratic to a particular country, to a continent, to a region, to an industry, and there's varying degrees of impact. Some, when you think about impact investing, there's grants and there's a nonprofit or NGO component to it. Some, there's a mix of profit and purpose and there's social enterprise, and some, it's completely for profit, but they're also driving impact and creating value for investors. So it is difficult to measure, because how do you go about standardizing something that you can't necessarily put a framework around? And when you have so many different exceptions, then it creates a challenge. So I think it's common practice for impact investors to report metrics primarily to their market success and how they've driven value, kind of in isolation, rather than evaluate and understand kind of where things fall short. Impact measurement done rigorously is a challenge. So how do impact investors go about threading that needle and measuring and documenting their impact? I know that there are a number of organizations that have tried to put a framework. I think in the lens of Africa, it's particularly challenging because it is so unique when you think about the 54 different countries. I know sometimes people from the United States or the Western world group them all together, but being someone who's studied the region, we talked today about regulatory framework, we talked about legal framework, they're all different. And so being able to compare across the board, there's always going to be an asterisk. There's always going to be context that's needed and understood. I think the UN, of course, Sustainable Development Goals have been touted as a universal framework for articulating, measuring, and managing the impact of an investment. And for many stakeholders, the existing methodologies are far from ideal and lack the desired depth. I mean, for example, does the metric provide, number of jobs provided, indicate, the jobs pay decent wages, providing safe working conditions, ultimately empower beneficiaries. So it's not just about jobs. So it's difficult to put a number on the benefits. There's a huge qualitative component to impact investing. And I see, just like, you look at Uganda with its rising youth population, and to shift to kind of the second part of your question, I think it's incumbent upon these emerging economies, in Uganda, to make sure that you are documenting in absolute terms what it is, the impact that you're driving, and telling that story authentically. I think there was roughly around 44 million people in Uganda, and I think nearly half of the population is under the age of 15. And that is a demographic, and that is a trend. I think we call that in economics the demographic dividend. It's a young country, and similar, and I say this out of my own experience, being born in the United States, being Indian American in the US, but just American when I'm travel to India, which I am here. India also has a huge youth population, and they have 500 million people under the age of, I think, 20, 22 in India. And so in terms of the future and emerging technology, I think being able to empower, being able to upskill, being able to leverage technology to take the vibrant, energetic, and committed youth population, so that at a relatively early and young age, they're gaining opportunities to contribute back to society. I think those opportunities along youth and education are somewhat expansive. based on my knowledge and study, I'm incredibly fortunate to have several of our team members from Girl Powered POC who are based in Uganda. I think two of them, my colleagues Kathar and Hillary, are actually at the conference today. And so I've been blessed to receive insight from, because we all have biased blind spots, and there's nothing like learning about a country from someone who's actually there. I think that in terms of opportunities, leveraging technology to take the resources, infrastructure that exist in Kampala, that exist in urban areas, and how do you find ways to leverage technology to take them elsewhere? Those are going to be trends that are increasingly important. There is a shortage of doctors if you just look within medicine and med tech. So how do you find ways that, you know, maybe it's not necessarily getting out all the medicines or patents, but how do you make sure that advice is something that becomes democratized? And of course, when you think about so many people joining the middle class, when you think about a growing economy, opportunities related to financial technology, you go from, hey, how do we help people become financially literate or financially confident? And then how does that translate into applying that so it's not just theoretical, in that they actually do become financially empowered and understand financial planning and have some notion of investing? I think those key themes in terms of young people access and finding innovative ways to be able to share resources in the healthcare and medical sector, as well as the financial one, are already well underway. And those things excite me, get me flying out of bed every morning, and which is a big reason why I was so honored to accept this opportunity to speak here. So I hope that was helpful, Reginald.
Yes, it was. Thank you, Samir. I know you have to leave. Thank you for making time. A round of applause for Samir. Back to Chipiwa, and then we'll end with Philip. Chipiwa, speaking of impact, I know there's been a lot of disagreement between impact investing and whether that flows into profit. What's your opinion? Should impact investors expect profit in Africa? What's your opinion and what's your experience on this?
Thank you for that question. And I'd start with saying it's a correct perception for people to generally think that it's difficult to have both impact and profit. And as Kim alluded at the session before, they are having to be a test case and take a hit in order to prove certain concepts. But in doing so, profit is essentially the last thing they are able to think about or can think about in order to achieve the impacts that they have to think about. Thank you for sharing that. It gave more insights to what the case is in Uganda. But I think you'll find that the case is true in many places on the continent as well, where impact is wanted, but because the financial industry was designed to push capitals where it would be most productive in monetary terms, it then becomes very difficult to argue the case of putting capital in places where value is not measured as it traditionally would, in this case, the value being impact to the society where the capital is deployed. So, and another challenge as well is, what constitutes impact? It looks different to different communities. It looks different in different countries, for different companies, for different entrepreneurs. What impact is would actually be a different measurable for them as well. So it's not impossible, and I say it's not impossible just from the perspective of working at Grow Power Talk, which is a social enterprise. It is for profit, but is often mistaken for being a non-for-profit organization. It is something that's possible to drive impact and earn profits as well, but it's something that would happen best if you think outside the box. Essentially, the more you think outside the box, the more likely you would be to achieve both impact and profit. But there are many case studies coming up. There are many entrepreneurs coming up and voicing their stories and sharing their journeys. and helping people realize more and more that profit can be a part of impact-driven initiatives, even if the profit is not the main aspect or the main reason why they got into the businesses that they're getting into. So in a nutshell, it is possible. It is extremely difficult, but it is possible. And in the African context, it would depend on what area you're focusing on, which country you are in, whether you have the support structures to enable you to drive impact and profit, how you would be measuring that impact. And if there are others who have gone before you who have paved the way for you to be able to derive profits from your impact projects. However, I would add that we are moving in a direction where at some point we will be left with no option but to have businesses that have impact front and center of their mind. Just for instance, looking at how energy trends are going, and countries worldwide are striving to meet a 1.5 degree target in order to manage the global warming situation that we find ourselves in. As more and more consumers become aware of how their activities affect the planet, affect sustainability, especially on the African continent, which has a lot of young people who wish to see many years of life on a livable planet, it will become imperative for companies to think of impact. Maybe not first, or if not first, at least give serious thought to what their impact is on the communities and the societies they interact with as they go about the business of making their profits. So in a nutshell, in my view, the fact that it's difficult is not an incorrect perception, probably more so difficult in Africa, which is unfortunate because we have a lot of impact to be had given where we are with, our historical legacies of colonization, of the lack of opportunity, of the structural issues that we have in the different countries with education, with healthcare. So we do stand to benefit a lot from impact investment. Unfortunately, it's difficult, but it's a difficult thing that we will just have to do as we seek profits, because at some point we will get to a point where the consumers and the world around us will no longer support or allow for enterprises that don't mind the impact that they have on the communities they engage with. Thank you.
Thank you, Chipua. Round of applause. Finally, to you, Philip. I would love to end this panel with exciting stories from you. Just give us one case study of a company you've successfully invested in as a VC fund. Why was it exciting? Is it because of the money you made? Or is it the impact? Or is it a combination? What sector? Just share your story. Thank you.
Thanks, Reginald. I think just building off what Chipua said in terms of impact, what part of the challenges that investors do have is Africa is small, fragmented, different markets. So one company to go from, say, Uganda to Kenya or to Zambia, it's quite difficult. You ask all the fintech companies that have to go and get regulatory licenses. And so because of that, the scale is not that exciting. You look at the number, I think Kim here talked about some of the PE funds that are really in the low double digits, which is not exciting when you have to look at what the bonds markets looks at. And so those are some of the, what I would say, the challenges, or why now impact is the leading one. So it's, and a big part is companies ask, I'm focused on profit, why the impact? And so trying to get them to say, yes, because of your profit, you can actually have an impact. But that said, there are some amazing companies here in Uganda and across the continent that we've seen. Two that I like to point to, that one we invested in and one we missed. One we invested in was out in Kenya, and they're involved in aquaculture. And they started off saying, oh, the tech route. We'll just give you a device, because everyone seems to be going the tech route. But then this was an IoT device to give to fish farmers so that they know when to feed their fish. But the farmer says, fine, this is fine, but where's the feed? Then they had to go backward. Okay, fine, but where do I get a market? Then they had to go forward. So they ended up playing a very supply chain role, because what you're finding more and more in Africa is there is no infrastructure. Every startup that's starting out is having to build their own infrastructure out. But that particular company has now reached about 8,000 fish farmers. The volume that they are doing, we invested them late last year, they've already crossed $2.5 million in US dollars revenue-wise, this company. The other company that I am very excited about, and similar models to come out, this was out in Zimbabwe. A company managed to convince the insurance regulators to consider cattle as an asset class. So the guys who have cows can now go get insurance, and that insurance, which is in our African sense, it is our livelihood. And so based on that, they are now able to go get insurance against their businesses and drive that, and they can now secure financing based on the cow that they have. Of course, the actuaries can do their modeling and all that, but those are kind of stories that have impact for Muntu and C. And so those are what we're tending to find, and we're excited about those ones. There's always the one you missed and the ones you get to invest in.
Thank you, Philip. Exciting. So we'll do one round of final remarks, starting with you, and if Samir and Chipio are still on, we'll do the same.
Super. Yeah. No, personally, I would like to say thank you to the CFA Society for putting together this, see the PE and fund sector come this far where there are people in a room. 12 years ago, I left a job in London to come and start an enterprise here. And of course, went through raising rounds. I think I got to meet David from Pearl, as well as Kim. Those are the only people here. Kim laughed me out and kicked me out of the door. But I would like to, wherever she is, say thank you. Because it's been challenging. It is hard work for both the entrepreneur and the fund manager. To see that we are at this point here is a big round of applause to all you guys in the market here. That hopefully in another 10 years, we'll be having more Kims and Davids who are doing more deals here. And by the way, hopefully local funds managers using local capital. So a big round of applause to you guys here.
Samir?
Thank you, Reginald. I echo the sentiments of being grateful for the opportunity to speak here, and I always fortune is in the follow-up, so I look forward to being in touch with many of you, and I'll definitely, I think that in order to truly, and I think a takeaway today for me is always that it actually is good in terms of being fiduciaries and stewards to diversify your asset class allocation with investing, because it is such a unique asset class and the opportunities for it are quite expansive. And I would encourage and challenge everyone here who is convinced to build new relationships and to learn more about one another, and let it be that, hey, we were able to impact lives and change the world and achieve a extraordinary rate of return because of that first conference that we did. I, being someone who is not from Uganda, I'm as passionate about the prospects and, as mentioned, the youth population and the opportunities, and look forward to learning from all of you and finding ways to synergize. And on behalf of our team at Girl Power Talk, many of those that had dialed in to listen to this, thank you again for the opportunity. It's been an awesome conference.
Thank you. Chipua?
Thank you so much, Janelle. I'd like to thank everyone for your time, and especially the opportunity to learn from fellow Africans in Uganda. I appreciate this platform that the CFA Society has created where ideas can be exchanged, and my hope is that the ideas shared and the strategies and issues brought up on this platform will not only give ideas to Uganda or East African nation, but I hope to some of these ideas translate to Zimbabwean context, which is, so it's that there's activity on the continent. People are grappling with different issues that we are facing, which are unique to who we are as Africans, to the countries, to the legacies we have, to how things are set up in an African context. It's been a truly amazing and memorable experience learning from the other panelists. And I look forward to more of the same being organized by CFA Society East Africa. Thank you, everyone. Thank you, and back to you, Reggie.
Thanks, everyone, for listening to us. It's been an honor and a very difficult task to compress an hour's discussion into, I think, a little over 30 minutes. I think to the detriment of the listeners. I guess you've missed out on a lot, but I hope the little that has been shared has been very instrumental. Thank you to the CFA East Africa Society and to the leadership of Alan, who has my very high respect. Thank you and a blessed evening.
Thank you very much, Reginald and the panel. Gus, that's been an interesting one. Cattle as an asset class. I suppose we had chicken as an asset class. We're pushing for tax reforms, but suppose we just pushed for new asset classes. Fish, goats. I mean, I'm just really dreaming there, but who knows? So thank you very much for sticking with us. And today's last panel gives us a little bit of insight of what we'll be talking about tomorrow. We will be looking at investable opportunities in the electricity sector. There's a lot of money being made there, infrastructure as well. So we'll be delving more in the opportunities that exist for us to explore this year. I'd like to thank you very much for sticking with us. We have come to, that's been our last session for today, our last panel discussion, our last session. However, there's going to be a program after this. Right now, we're going to break off for a tea. There's going to be a tea break. Make sure to get this tea. You've earned it. You've been an excellent group. Thank you so much for being with us. It's been pleasant to move with you this journey so far. Make sure to come by tomorrow. We're going to have coffee, and then after that, we will have a very important session. We are going to be awarding new charter members, and that's a very big occasion for Uganda, because the more charter holders that we have of the CFA Society, everything moves. We get to have new asset classes, we get to have new structuring, we get to have more expertise to improve the capital markets. We'll be doing this after the coffee break. So a round of applause to everyone. Thank you so much from myself and Lisa and the CFA Society East Africa. We thank you for your patronage today, and let's break off for coffee. Thank you very much. Oh yeah, everyone is invited to the awarding ceremony. We're going to break off for about